Hi, let's start exactly where private equity starts, with return on invested capital. In a PE environment, the clock is always running. The investment is leveraged, the window is short, and the expectation is transformation followed by profitable exit, typically inside 5 to 7 years. And from day one, every operational decision connects back to that outcome. Hiring, pricing, investment, sequencing. All of it eventually shows up in the multiple of invested capital. ROIC and IRR, the internal rate of return. Here's the structure as operators see it, not the legal version, the practical one. HoldCo sits at the very top. This is the equity reporting layer. It receives the capital from the PE fund and manages governance. BidCo, or the acquisition vehicle, executes the purchase. Its primary role is to incur the senior debt and receive the equity from HoldCo. MidCo, sometimes FinCo, is the debt management engine. In a buy and build, this becomes the layer that consolidates the debt, unitranche or PIK loan, note and facilitate cash sweeping. And the OpCo, the operating companies, holds the physical assets and generates the EBITDA. Here's the part that matters. Cash flows up, leverage flows down, and FP&A sits right between these two forces, explaining how operational performance services the debt, how covenant compliance is protected, and how investor returns are ultimately shaped. FP&A inside a PE-backed company isn't about reporting cadence. It is definitely not about quarterly EPS. It is about liquidity management, value validation, and predictive precision, especially under leverage. Every operational decision must trace back to free cash flow, debt service coverage, and return on capital. That is the anchor. And practically, that shows up in 4 ways. Driver-based modeling, pricing, volume, headcount, cost, every operational lever trace through to EBITDA and cash conversion. The model becomes a real-time simulation engine and not a static budget. Synergy capture and integration. When companies are acquired, FP&A doesn't just consolidate books. It quantifies redundancies, it tracks synergy realization, and it builds the consolidated efficiency view of the operational sponsor. And then the third one, we're talking about liquidity and covenant monitoring. Interest coverage, leverage ratios, available liquidity. These are existential metrics. Forecasting must be continuous, stress tested, and transparent. And then you have scenario and exit planning. Everything ties back to MOIC. The model must continuously simulate how operational progress or shocks support the maximum exit multiple or erode it. When you break a PE transformation down, it follows a familiar pattern: acquire, integrate, optimize, exit. FP&A makes that loop measurable from day one. Synergies are tracked and their realized value quantified. Margin uplift from efficiency project is validated against the investment thesis. EBITDA to cash conversion becomes transparent and actively managed, and the quality of earnings, ensuring it's recurring, cash generating, and sustainable. It's validating for the next buyer. This is why FP&A becomes the bridge between the day-to-day operations and the investor's value agenda. Now, take investment for growth, IFG. The intention is always positive. Bring in more people, increase marketing, invest in tech, expand internationally. But without the driver-based modeling, the real cash impact gets lost. And here is what usually happens. IFG spend phase. Payroll, marketing, capex rise quickly, cash flow drops immediately, growth lag, phase, revenue lags, the associated cost by 6 to 12 months. Cash impact phase, liquidity tightens, working capital strains, DSCR begins to pressure covenants, and then you have value erosion, post-mortem MOIC, IRR decline because cost absorption outrun revenue realization. FP&A's job is to prevent that. It converts every dollar of IFG into a forecasted return, monitored through leverage, cash flow, and IRR impact, not aspiration. I have worked inside PE-backed transformation, building driver-based FP&A systems that make growth measurable, predictable, and manageable. This isn't theoretical work. It's translating real operational pressure into clear financial logic that leadership can act on confidently. In a PE setting, FP&A delivers 5 strategic outcomes: integration, capturing synergies and validating operational efficiency, forecasting, continuous liquidity and covenant modeling, value creation, linking operational levers directly to MOIC, exit readiness, internal rate of return, modeling and quality of earnings simulation for the buyer, reporting consolidated standardized data packs the financial sponsors can trust. From company to company, from assignments to assignments, what we always say is very simple. Done well, FP&A keeps strategy, execution, and financial constraints aligned. Done poorly, even promising strategies collapse under unforeseen cash and leverage pressure. Private equity transformation depends on precision, velocity, and accountability. FP&A's role is to make all three work together, not in theory, but in everyday decisions that shape value. It turns operational intent into measurable investor outcomes. Clear, predictable, and disciplined. I'm Hamilton Alogaga. I build FP&A systems that anchor execution to financial reality, protecting value, growing value, and making the entire investment case more reliable.